consolidation. Man, I know for a fact that I've been stuck in consolidation with like 4 or 5 losses. And by the time my trading day has done, or by the time my trading account is done, I look back at the charts and I'm like, oh man, this was just consolidation. I got stuck in consolidation. So when does consolidation usually happens? We really have to understand when does it happen. No one really talks about when they happen or how to anticipate it, or I mean, these things are really important, and if you don't know these things, then it's going to be really hard for you to take trades, right? So when does consolidation usually happens? Consolidation happens when there is low volume in the market. When there's extremely low volume in the market. Oh wow, we have 400 people here, man. Nice. We have 400 people with 5 cameras on. Awesome. So when there's like low volume, when we have low volume in the market, right? And then we also have consolidation between high volume times and before news at times. So what this basically means is, now let's say we have Usain Bolt. Usain Bolt runs a marathon. He runs, keeps on running, and then he takes a little break, right? He takes a water break like this. He's taking water, drinking water, and either he keeps on running or he keeps on going back, right? But he's going to take this water break. Consolidation. This is what price does. Whenever there's a burst of volume in the market, after a burst of volume in the market, there's going to be some sort of consolidation. Like price has to refuel. It has to kind of stop and kind of consolidate a little bit. And when you look at this consolidation from a fundamental level, like let's say when someone's working at an institutional bank, you're working at a bank and you're like, okay, processing orders and stuff like this. Now, you're going to have time when there's going to be a lot of volume, right? You come to the office, you process orders, and then time comes when there's break time. When there's break time, then no one's really looking at the data, everyone's out for lunch or whatever, having sushi. Now, when everyone's out for lunch, this is when there's consolidation in the market. After London close, it's lunchtime, or after in the afternoon time, there's lunchtime, when no one's really looking at the markets or processing the data. That's when you have ranging happening, which is why most times after Asian session around 10:30, man, if someone trades the Asian session after 10:30 p.m., you're playing yourself. That's a bad habit you're putting yourself into, because that's when there's a lot of consolidation there. So, I mean, it's no good. So, consolidation happens when there's low volume times, between high volume times, between maybe New York open and London close, there may be some sort of a half an hour of consolidation. And before news, sometimes you may see on gold or GJ, or maybe on US 30. I know we have a lot of fans of US 30 here. You might see some sort of consolidation, and that only happens when there's news about to happen. Right? Sometimes when there's going to be high volatile news, it's going to be very calm. It's what they say. It's always calm before the storm. Whenever price is ranging before, let's say, interest rates or NFP or FOMC, for a fact that there's going to be a big move coming on. The longer the market ranges, the harder there's going to be a move. So, identifying consolidation. How do you really accurately identify consolidation here? So there are 2 ways to identify consolidation. One is during an uptrend. Second is during a downtrend. When price is trending up, it will create supports to obviously, break the highs that we talked about. Again, when price is trending up, it will create a support. A support is created to support price to continue going up to break the highs. When it cannot break the high, then it will obviously create a resistance, right? If let's say price makes a high like this, comes down, and if it now continues to go up to break the high, if it cannot break the high, it will obviously come down, and then you have a resistance formed. If you have a resistance formed and price continues down, the price looks and says, hey, wait a minute, we got a support right over here as well. So now what's it going to do? Now there's a higher chance it will consolidate. This makes sense? I think it makes sense. If we can't, if price is going up, it's creating lows to break highs. If it can't break the high, then obviously it's going to start to consolidate. So let's take a look at that example over here. All right, let's take a look at this. We have a support forming right down over here, right? We got a nice support forming here, and you have a candle closing. Now, I don't know if we drew this. Okay, yeah, perfect. We're good. We have a candle closing bearish, right? We have a candle closing bearish. Now you're like, okay, you know what? We're at the support, candle closing bearish. We can't take a sell because we're at support. We can't take a buy because price is not bullish. The candle is not closed bullish, it's bearish. So we got to wait. We wait for a candle to close bullish. We're like, okay, perfect. Candle is closed bullish at a support. Let's say this is a 30-minute time frame or a 1-hour time frame. And now what we're going to do is we will take a buy, and our stop loss is going to be below the candle, and we're anticipating price to continue going up. We're like, okay, perfect. Let's go up. All right, you take a buy, price moves up, you're in profits, you're perfect, things are looking good. We're running good, price moves into more profits, and now you're like, okay, you know what I'm going to do? Maybe now I'm going to put stops at break even because, we're running in profits. So now what I want to do is I want to wait for price to maybe come down, create a support, so I can add another position, and then price can continue to go up. Or what you can also do is, now, here's the thing. When you're adding positions in two ways. One is aggressive, and one is very conservative, right? The aggressive adding positions is that you're adding, so once you added position on this candle, the second you're adding it on the anticipation that the next candle is going to start making higher highs and higher lows. That's when you're adding the next one. This is when you're aggressive because you're really anticipating the next candle to respect the low and continue moving up. This is very, very aggressive entry. This is kind of like buying the high and really anticipating price to go up. But at the same time, you're also keeping in mind that this candle can continue coming down as well. So whenever you're taking a trade, you're always looking to see how much risk you have on the line. You're always looking to see that, okay, candle can continue come down. So you're always looking at your risk as well, right? So, okay. So let's say you have a buy running and you're anticipating price to go up. You're like, okay, perfect. Price is heading up. And now you see a resistance forming at this point, right? You're like, okay, I'm in a buy, right? I'm in a buy right over here. Let's say you have another buy, which is right over here. And now once you have a buy over here and down over here, and you have a candle closing bearish, at this time you're saying, okay, you know what? Since we have a candle closing bearish, this means there's a higher chance for the next candle to come down as well. So how do I want to manage this trade right over here, right? Do I want to leave this trade open and let price hit stop loss? Or do I want to put my stops at break even and I want to exit the trade at break even? This is something you have to battle with yourself. Do you want to close in a loss or do you want to close at break even? Most people will say, okay, you know what? I'm going to remove the stop loss, right? I'm going to remove the stop loss and I believe it's just going to go up. I'm going to remove the stop loss. Don't be that guy. Be very confident in what you do. Either you're going to close in a loss or you're going to close at break even. Nothing more, nothing less. I think it's fool's gold where you just remove stops. And man, like this one time I went to a $26,000 drawdown just because I decided to remove a stop loss on my $40,000 account. And it was a bad fucking day. And I closed in a $26,000 loss. And then the next day price went my way the next day. And if I would have waited, I would have just been like, okay, you know what? I'm going to just close it out and I'm going to wait. I would have executed that trade and overall had a profit, but it is what it is. We learn and we move on. So perfect. We have a resistance forming. So what we need is a support forming for price to move up, right? Next candle comes down. You're like, okay, perfect. Candles are coming down. Our entry is down over here now, the first entry. And now you have candle coming down further and it stops you out. This is what's going to happen. Your runners are going to get stopped out 80% of the time. When you see people posting these big trades running here and there, man, listen, they don't happen all the time. It may give you an illusion it happens all the time because they may post it every other week. It may give you an illusion it happens all the time, but I can promise it doesn't happen all the time. It happens maybe 10% of the time, maybe 10, 20, percent of the time your runners are going to run into 100 pip profits, 150 pip profits, not all the time, right? So price came down. Now you're like, okay, I'm going to wait for support. All right, support formed. Now you're like, okay, you know what? Now what I'm going to do, I'm going to now take a buy because a support has been formed right over here. So you're like, okay, I'm going to take a buy right over here, and I'm going to place my stop right down over here, right? Now you're taking the buy, anticipating price to break resistance because, we're bouncing off a stronger support. So it should break like a secondary resistance, So you're waiting. You're like, okay, perfect. I took a buy, price to go up. Price went up to this minor resistance. It closed at below this resistance. Now you can do two things. Now either you can keep your stop down over here, right? Below where the stop loss was originally. Or what you can do is you can bring your stop loss up below this bullish candle. If you're going to bring your stop up above the bullish candle, now you're bringing your stops in profit. And now you're also trusting that the market is going to respect the low and continue moving bullish. And now let's see what happens with the next candle. What the next candle does is it forms bearish and forms under resistance. This is the time when consolidation is about to start. This is the time when consolidation is about to start because now you have a support formed, and now you have obviously like a resistance formed up over here. This is a consolidation now, right? What some people will do now, the consolidation, it's very hard to train your eyes to identify consolidation early, but with practice, you're going to get good at it, right? But for the most part, you're going to look at this and say, yeah, we're forming consolidation. I think it's still going to go up, so I'm going to keep my trade in, and when you keep your trade in, you're like, okay, you know what? Your trade gets stopped out. Price comes down, you're like, oh man, it didn't really break up. Like, what the hell? Wait for next candle forms like this, and next candle, now you have this resistance formed. And now price is just ranging here, right? So the more you anticipate candles to break up, the more you're going to get stuck in the trade because, now it's just resistance formed. Now, if let's say we had this area right over here, right? Let's say we had price over here and you still think price is going to go up. The best thing for you to do is to wait for the next candle to break the high of this previous candle. Because once the next candle breaks the high of the previous candle, then okay, now price is going to go up. So at this point, you can take an impulsive trade, like, okay, we've broken the high, so now it should continue to go up, or you can wait for the candle to close above here and then try to take another buy to potentially go up. But essentially at this stage, we've just consolidated. So, it's like the first sign you see of resistance, that's probably the best sign that the consolidation is going to start now. Okay, so let's go towards the next section over here. Let's just remove all this. All right, identifying consolidation part 2, right? So when price is trending down, it will create resistances. Oh, let me see what's the time right now. Oh, 9:20. When price is trending down, it will create resistances to break the lows. When it cannot break the low, it will obviously create support, and there's a very high chance it will create like a range. So basically, what we're talking about here is like if price is trending down from a resistance, it will come up, trend down, come up, and then trend down to break the low, but it won't break the low. It's going to start to bounce. And when it starts to bounce, it's going to look left and see a resistance here, and then it will maybe start to range here. The complete opposite of what we saw in the previous example, right? So let's take a look at this here in more detail. Let's take a look at the candles here now. So now you have a resistance forming right over here, right? You have a resistance forming, you have bullish candle coming up, and then you have a bearish candle coming down. So when you have a bullish candle at resistance, you cannot take a buy because we're at resistance. That's basically it. Like when you have kids, I'm sure a lot of guys here have kids here, a lot of girls here too. Like if you have kids, you tell your kids, hey man, listen, don't touch that. You're going to hurt yourself. But the kid is like, no, I'm going to touch it. They touch it. And then they figure out, oh, okay, I get hurt from this, so obviously I'm not going to go touch it. But then there are some kids who touch that over and over again. They don't learn, and we are those kids. We're grown-up kids where we see a candle moving bullish at resistance. We know that it's at resistance. We have to wait for candle to close to see if it closes above or below, but we still take a buy. And when the candle closes below resistance, we can't take a buy because it hasn't broken it. We can't take a sell because the candle is bullish, right? So you wait for a candle to close bearish. So when you have a candle closing bearish, at this stage, you're like, okay, you know what? This is now a good confirmation to take a sell. So you're like, okay, you know what I'm going to do at this stage? I'm going to take a sell maybe right over here, and I'm going to place my stop above the previous candle. It's really, really important to place a stop above or below the candle on the 30-minute or the 1 hour, because, hey, listen, if the next candle spikes up, guess what? You're going to be out of the trade, right? And you're only going to lose what you planned to lose. Let's say if you have a $500 account, and if your risk over here was, okay, let's say you told yourself, hey, Mario, okay, let's say myself as Mario. I'm Mario, and if price hits the stop loss here, I'm going to lose exactly $25. So that's what you're coming into the trade with, $25. If let's say price starts to go up and you remove your stop loss, now your loss is infinite. Now you're open to whatever loss you're going to get. So it's really important to have a stop, man. It's really important to know exactly how much you're going to lose, because now you're going to be much more calm. You're going to be much more relaxed in this trade, right? So let's say you took a sell. You took a sell, and now you're waiting for the next candle. Then the next candle starts to go down, bearish. Next one goes down bearish. So let's say this candle closes bearish here, and now you're like, okay, since we're in a downtrend and I'm an aggressive trader and I have a lot of experience, what I'm going to do is I might want to take another sell over here, and now I'm going to place my stop above the previous candle. And then you go to the next candle goes down, next candle goes down further. Now you see how candles are making lower highs and lower lows. Lower highs and lower lows means you have opportunities to enter positions as the highs are being respected. Now you have to understand, again, these highs will only going to be respected much more on higher time frames. Your 30-minute time frames, 1 hour time frame, 15 and the 5-minute time frames, it's not really important the highs are going to get respected. It's just the way it is. They're like weak confirmation time frames. So perfect. You're in a sell, candle is coming down, and now you see a bullish candle form. And when you see a bullish candle forming, you can see that it's breaking the high of the previous candle. When a candle is breaking the high of the previous candle, it just logically makes sense that the next candle will not go down. There's a higher chance for the next candle to go up. So now you're going to wait. Your entry is, let's say you have an entry right over here, right? So now you're waiting for price to maybe create a resistance under your entry so you can add another position. Right? It's really important. Add. Now, when you're looking to add positions, you're not going to be able to add positions all the time. It's just not going to happen. You might be able to add them maybe 10% of the time or 20% of the time, but that's an added advantage you have in taking a profitable trade, right? So next bullish candle, it comes up and just taps it. It just taps your entry, which your stop loss was at break even. Obviously, you secured positions here and you got stopped out, right? And then price starts to go up, and now you have a candle closing bearish. Now when you have a candle closing bearish, at this stage you're like, okay, you know what? This makes sense. Now if my position got stopped out, this is an opportunity for me to take another trade, because now the candle is closing in my direction. Right, so now I can possibly take another trade. So now, Mr. Jan here says that, okay, you know what? Now we're going to take a sell. So you execute a sell here, and you placing the stop above the previous candle. Now, one important thing is what most people do is they place their stops right at the wick of the candle. That's what they do. They place them right at the wick. And this makes no sense, man, because what if the next candle comes up right to this wick just below it? What's going to happen is the spread is going to take you out. I'm guilty of that. Spread has taken me out all the time. So now what I do, I place my stops a couple pips above the candle so that I don't give spread a chance to stop me out. I think that's very important. So perfect. Now you're moving on to the next candle. You have candles coming down. Now you're in profits. You took an entry right over here. Your stop was right over here. You're in profits right now. You're like, okay, you know what? We're going to come all the way down and we're going to break this low because there's volume in the market. It's NY open and we're going to have a great day. And the next candle closes bearish as well, but the body becomes smaller. You know, when you're looking at the charts, you're looking at every detail, man. You're looking at the wicks, you're looking at the bodies. Notice how these bodies were smaller, right? You had a big volume body, and you had small bodies here. You have a big body, you have a small body. When you have small body candles, this means they're weakening. The momentum is weakening at that point, right? Just like an army. You know, you have army. Like in the front, you have the weak, you have the weak soldiers, and at the back you have the strong soldiers. Actually, that was a dumbass example. Forget about it. So, all right, let's move on. Okay, so then you have, instead of breaking the low, you have a candle closing bullish. So now when a candle is closed bullish after bearish candle, you formed a support, right? You have a support formed and you have a minor resistance formed right over here. And now price may start, like ranging. Now, one more important thing is that if you had a sell at this candle, right, and if price moved down over here, you have brought your stop loss from up over here to above this 30-minute candle. You know, if you've secured positions down here, you've moved your stop above the previous candle, because if the next candle breaks the high of the previous candle, then the downtrend is invalid, right? Like a downtrend is invalid if the previous high gets broken. An uptrend is invalid if the previous low gets broken, right? Very important. So this candle broke the high and your stop was right over here and you got stopped out in profits. You know, you don't go in a drawdown. No, man, you got stopped out in profits because you were playing safe. Now let's see what the next candle does. You know, now you have a support forming. So basically we have a possible range here now. We've identified a range here. Right? It's very important. So whenever you're taking a sell and you see a support forming and you've taken a sell at like a resistance and now you've seen support forming, that's an opportunity for price to create a range, to create consolidation. And we don't trade in consolidation. But we have some cowboys who trade consolidation. So that's what we're going to answer. Can we trade consolidation? Because I know some people are thinking, oh yeah, but you have consolidation, you can take a buy and a sell, that all works. But what I want to know is, how's my pace? Is my pace good? Too fast, too slow? Like, I know it's a little bit of advanced, but I'm trying to keep it as simple as possible. All right, perfect. We're still working over here. All right, so let's turn the gulag back on over here. All right, so can we really trade consolidation? That's what we're going to answer right now. All right, let's see here. Let's see if this is still being recorded. Well, I hope it is. Yeah, I hope it is. Okay. All right. We got him laying down in his bed, man. You gotta sit up with a notepad. All right. Let's take a look. Trading consolidation is risky, right? It's really risky when you're trading consolidation. You have to make sure you have enough range. What I mean by that is, like, how do you define range? A range is the difference between two zones, right? So one zone you have right over here, which is a resistance zone. Price came down, came up, created like a minor resistance, and then it came down to retest the low. So what basically happened in this range is that price came down to create a low, right? It retraced. When price retraced, there's a very high chance it will come down to retest the low. And then it came down to retest the low, right? And now you can, I guess, from these past few sections we've been through, I think a lot of people can now identify how price came down to retest this low, right? How candles were making lower highs and lower lows, and now automatically you're visualizing where your stops would be, where your entries would be. I guess everyone knows that by now, right? So we came down to retest this low. So now we've created a support. We have a resistance forming right over here, right? Let's say that this whole length of this range, let's say this range is around 20 pips, right? Let's say you have a 20 pip range. If you have a 20 pip range, I don't think this is enough range to take a trade, because if this candle has already moved, now this range basically becomes maybe 15 pips, you know. And if you try to take a buy over here in this 15 garbage range over here, I mean, this is going to be a very short-lived trade, right? For example, let's say if this range, instead of being 20 pips, is 50 pips, right? If you have a 50 pips, now you have a much better opportunity to catch a trade. Now you have a much better opportunity to catch like a trade heading up, you know. But if you have like a 20 pip range, you can maybe get maybe 8 pips, 10 pips. I mean, you got spread of like 2 pips. So 2 pip spread, 20 pip range, you got 18 pip range, 18 pip range, you got a candle move like this. Now you got left to what, 15, 14 pip range. Out of that 15, 14 pip range, you can only get like maybe, 8, 9 pips out of it. It's going to be very hard. But if you have a 50 pip range, man, if you got a 50 pip range, you can easily get like 20 pips, 15 pips out of it, as long as your entry is down over here and you're targeting maybe up over here, or even if you're targeting like, this area right over here. This area might also be, let's say if this, this could also be like, 20 pips. So if you have a 20 pip range, 25 pip range, you can easily get 10, 15 pips out of it. So the best way to trade consolidation or the range is to measure how big that range is. If it's a small range, it's going to get very risky. You might not get the move you want. If it's a bigger range, then it's going to now in a bigger range, you have a higher probability of catching a trade, right? So obviously, when in ranges, you're looking at the candles closing, the way the candles are, forming highs, making lows, or the candles are really like making small body candles or big body candles. It's very important. Let's see here now. Okay, positions in breakout. So first we have consolidation, and next we're going to talk about when price is breaking out of a consolidation. Now, since this webinar started, we only talked about uptrend, how to manage uptrends, how to identify uptrends, how to add positions in uptrends, how to put like stops in uptrends. Same thing with downtrends we talked about. We talked about, consolidation, how to identify consolidation. Obviously, you'll have to watch this 4 or 5 times to really understand these concepts. Now we're going to talk about how to trade when price is leaving consolidation, when we're breaking out of consolidation. So this is basically called breakouts, like when price